Welcome to the #InvestThis podcast, where the secrets for real estate investing are revealed. Now, here's your host, Scott Bauer.
And welcome everybody to the 53rd episode. I think that's right, 53rd episode of the #InvestThis podcast. I am your host, Scott Bauer, and today I'm excited because we're going to talk about something a little bit different. We're going to talk about how to utilize, your retirement accounts to invest in different things. So I'm going to let Bernard Reisz, who is with us today, explain a little bit more about that. But to start off, he is a CPA and a principal at Reisz LLC. They specialize in real estate debt and equity investing using retirement funds. He personally invests this way and assists others in doing the same. And by giving investors checkbook control over retirement accounts, they give them the ability to invest their IRAs and 401ks and assets in asset classes that they choose. So Bernard, welcome to the show. How are you?
Great. Scott, great to be here. Great to be on the show. Looking forward to sharing lots of value.
Absolutely. Why don't you go ahead and give the listeners a little bit more about your background, maybe how you got started in this space, and then we'll go into what you're focused on now.
Yeah, well, let's do that. So I am a CPA with a background in tax and financial due diligence. So the tax side is what immediately comes to mind to people when they think of a CPA. But there are other things that CPA lends itself to do. So we were doing what are called agreed upon procedures, looking at some of the biggest companies in the world, verifying that their books and records are okay and they're adhering to their loan covenants and agreements that they've got. I'm probably not supposed to drop the names online. We're supposed to keep that stuff, to ourselves. But some of the, household names that we all recognize. And as part of that work, there was a heavy focus on middle market and closely held companies. And when you deal with these large companies and their owners are high net worth people, they're getting all sorts of financial stuff pitched at them all the time. And what I keep seeing again and again and again is that any people that are pitching financial products are always pitching something that they're incentivized to sell, and people are not getting the full picture. And that really, from maybe in a personal way, character, ethics, it got to me, and I thought we've got to offer people the full array of solutions, including the ones where nobody's making a commission. And one of those is the checkbook control retirement accounts. So when we say that we're involved in real estate equity and debt investing, we don't actually control any assets. We give people the tools. We enable people to invest. We have a really low reasonable fee to get the structures in place. But people do their own investments. We have nothing to sell. It's about giving people control so that they can do what they want to do and not feel restricted to investing their money in something that somebody else wants to sell them.
So that brings me into the first question. I mean, you mentioned how you kind of did this out of being more transparent to the public, right? I mean, showing transparency and giving people control of their own money, and you not, taking a big fee for giving them that ability. Is that about right?
That's exactly it. And to be perfectly, I know every aspect of the financial world very well. I've got, in addition to being a CPA, I do have an insurance license.
Okay.
And a securities license. I don't use those, but I have them, so I know the ins and outs of more or less every nook and cranny of the financial space.
Okay.
And it's really about giving people the tools. We're not out there to say, hey, do this. We're say you can do it. You should know that you can do it. And your regular financial advisor is never going to tell you that you can do this. He may not even know that it's doable because he's come up through a system that teaches him about the products that they sell. So it's not necessarily that anybody has, evil designs. It's just about incentives and how the financial system is organized.
So, I learned a few years ago about the difference between a financial advisor and a fiduciary advisor, and how much of a massive difference that there is. And how, to your point, sometimes the financial advisors are selling you a product they don't know is a bad product. They just know what they were taught to sell, right? They were just, this is what they were brought up to sell. And of course they're making a commission, but as a consumer putting your money at risk with a financial advisor, you're not always protected, right?
Oh, you're not protected at all. There's something called a registered investment advisor, and then there's something called a stockbroker. From a technical perspective, a stockbroker is held to a suitability standard. An investment advisor is held to a fiduciary standard. So the stockbrokers, from a compliance perspective, they can get away with selling just about anything because the suitability standard is not really that high. The fiduciary standard is a much higher standard of care. However, again, everybody is coin operated. So they're not going to if you walk into a financial, actually I heard that from not a financial advisor, from even the financial industry. It's ultimately about delivering product. That's really what it is. So I was talking to somebody at one of these people, when you go into a financial advisor, or even a fiduciary, and they'll send out like, hey, you can do this investment, that investment. Very often they're really resellers. And their role is to just get the assets under management. And on the back end, they're outsourcing it to a third-party company that manages the investment. So when I was talking to a business development professional from one of those third-party companies, and they were trying to get me on board to sell their product, that's one of those guys taught me this. He's like, hey, Bernard, we're all coin operated. So it's actually coming out of the horse's mouth. Wow. So he we're all coin operated, but we try, some of us, people try to be ethical and do right by their clients. But at the end of the day, if somebody is a registered investment advisor or a stockbroker, they're going to present the tools that they can work with. It's not even fair to expect them to present the tools that they can't work with. So when you walk into their office, they're going to tell you generally about mutual funds, stocks, bonds, annuities, and among those products, the best advisors will present you with the best options, but they're not going to present you with options that they can't monetize. And everybody that looks to a financial advisor should be aware of that. They should know that there are other options out there. A financial advisor is a great tool, but you should know its limitations and don't think that the financial advisor is giving you the full menu, the full array of options.
But now you had mentioned that a fiduciary advisor is going to do the same thing, where they're not necessarily going to give you an array of all of the options. Yet I thought that's what a fiduciary advisor's job was.
So their job is they can't sell you a product that's bad for you, right? But if at the end of the day they give you a mutual fund that's seems to be good for you, does that mean it was better for you than buying a rental property? Perhaps not. But at the same time, there's another key aspect to understand about this. They're in a business that's built on efficiency. They've done a great job of being able to set it up. You sign at the dotted line, you click on the computer, it's a few clicks, and you're good to go, right? And then they can move on to the next client. You have a quarterly meeting with them. You talk. Maybe they click on the mouse again to rebalance the portfolio, but it's very automated, and nobody's really taking that much risk. If a financial advisor is really limited, because suppose he suggests real estate. Well, the first hurdle he has is his compliance team behind him may say, you can't do that. Or there's no way to automate it. You can't click a mouse and buy a house. It just doesn't work that way. So they're not set up to do it. And then there are certain things that choices you can only make for yourself. It's not reasonable for a financial to expect a third party to make these choices for you. If you'd like to say, hey, I'm thinking about quitting my job and going into real estate full time, that may be a great plan. It may not be a great plan, but anybody that's sensible recognizes that there's risk associated with that. And you should understand the risks of that decision and the reward, and you can do it. A financial advisor will never, ever tell you to do that. Of course, he doesn't profit from it if you do that, but it's also what happens if it doesn't work out and you come back to him with complaints, right? He can't tell you to do that because there's no upside to him and only downside. there are certain risks and choices that we have to make for ourselves. And if there's one message that I would want to convey to people is, it's really about taking charge. A lot of people, we think that we find advisors and we can kind of outsource our finances. We really can't do that. At the end of the day, we have to take ownership of our own finances and financial choices. If you determine that, hey, you want part of your portfolio in mutual funds because you surveyed all the options and you want part of that in mutual funds, by all means, get a fiduciary advisor to take care of that component of your finances. But don't walk into a financial advisor's office thinking like, I don't have to think about this anymore. I'm just going to come in here and whatever he tells me, I'm going to do. That's a mistake.
Yeah, you know what? And I think it's really easy to fall into that mistake, really, because the layperson out there, I mean, even myself included, I'm very focused on what I do on the daily basis, that I don't necessarily have the time or the capacity or even the knowledge. I mean, I'm pretty knowledgeable when it comes to finances, but I don't know each and every product out there. I don't watch the cycle or the market all the time. I don't have eyes on it like that. So I can't make the most educated decisions about things all the time because I just don't have that knowledge. I'm not in the space. So therefore I rely on a fiduciary advisor for some of my investments that I have. But to your point, I mean, I don't trust him with all of my money, and I don't trust him with all of the decisions when it comes to my finances. So how have you been able to change that?
Right. So what we do is we give people, one of the key things that financial advisors focus on are IRAs and 401ks. And what we do is we keep money within these tax advantage accounts, but in a way that investors have direct access to the money to put into deals, to deals that they control, to deals where there's an inefficient market, deals that have a much more attractive risk reward profile. And it's good, this is a little technical, but it's good to talk about, how the stock market works and how alternative investment works, like real estate. The stock market is what's called an efficient market. And what that means is, like, your financial advisor, any financial advisor, there's really very little that they can do for you. And that's been more or less conclusively proven time and time again. Almost all investors are best off buying a diversified portfolio and sticking with that, and not trying to pick stocks or time the market, because that's a losing proposition. So if you're going for a financial advisor and he's doing that for you, he's probably not doing anything for you except charging fees. He's probably not enhancing your returns. And again, that's because the market is set to be efficient. And there are billions of people the world over that are looking at the stock market, and they're all making their best guess the value of a stock. And the stock market is exactly that. It's a market that aggregates the buyers and the sellers' inputs, and they settle on a price. So the market price is generally everybody's best guess, kind of the world's wisdom of what this thing is really worth. So when you buy it at that price, you're not getting a deal, and you're not getting, a value add opportunity. Your financial advisor is not calling up Apple and saying, you know what, I want to do a little repositioning here. I bought the stock and now I want to, he's not calling up Elon Musk and Tesla and saying, okay, I bought some Tesla stock for my clients because I think there's a great opportunity. I think Tesla should do a rebranding, a revalue add, and then the stock price is going to go up. He can't do that. He can buy it and he can look at it, and that's it.
Yeah. And then he can sell it if he wants, right? I mean, that's about it. That's your limit.
That's it. Whereas you talk about alternative investments, which are not available by clicking a mouse, right? So it's inefficient. If you're in a market, you can get that foreclosure, maybe you can get that off-market property, or you can have a better way to reposition the property. You can have insight and you can execute. You can do something to actually increase the appreciation and reduce the risk. As somebody that's a full-time real estate investor, you can do things that the guy down the block can't do. You're all looking at this property, but you know something that other people don't know. So alternative investments can present at least a much more attractive risk-reward profile. You can have lower risk and high reward if you know what you're doing.
That was really one of the reasons why I ever got into real estate at all, is because I knew that was one of those asset classes that will always be here. Now, the capacity that it will be here is going to change, whether our entire world is going to go to only apartment buildings, because that's the way that the universe seems to be, moving to, or if everybody's going to have a single family house or, community living, whatever it is, there's always real estate. That's just for living. All the businesses are in real estate, all the parking lots you park in, all the grocery store, it's all real estate, right? So that's never going to go away.
Right. Yeah. And you can't import it from China.
Right. Yeah. I know I'm not getting my house from China. That's for sure. So, that alternative investments like real estate have been super powerful for me. I mean, that's how I've started and grown my entire business and continue to do so today. But now, you'd mentioned at the beginning of the call that you don't really take a big fee for organizing this. So let's actually dive into kind of the nuts and bolts about what it is that you do. I'm sure a lot of the listeners know about self-directed IRAs, self-directed 401ks. Is that what your company is, or is it a little bit different?
Right. So we've got a unique angle on this. What we focus on is structures that reduce the fees and increase the freedom. So people may be aware of self-directed accounts where the money is held at a custodian. And the custodians have to process all the investment paperwork. You got a deal, you need a funding, you got to send paperwork, you got to put the deal together, put the paperwork together, then get the custodian's paperwork. You got to make sure you cross all your T's, dot all your I's, send it into the custodian. They review the paperwork, they've got processing times, all goes well, you'll get your money, but it can take a couple of weeks. If not, sometimes you need your money in a hurry, and that's going to come along with a fee. And the fee is essentially paying them to rubber stamp the deal that you put together and to wire out the money. If you need the money in a hurry, you may not get it in time, or sometimes you'll get hit with an expedite fee. We know people paying thousands of dollars just in their expedite fees because they need the money into the deal. There's a closing. So what we do is we set it up so that you get the money in a bank account and our clients control the money themselves. So there are no transaction fees whatsoever. And if they're at an auction, be it a tax lien auction, it's a foreclosure, a sheriff's auction, whatever kind of auction it is, they can just write that check. Because I'm guessing you've been to some auctions. You've got to, at the very least, have certain.
Oh man, the funds
up front. Oh, just a moment. I've got a message here. Your internet connection is unstable. Was that me or you?
You sound better now, so I think we're okay.
Okay, so I'll just back up 10 seconds. And the idea is, if you're going to buy stuff at auction, so you need to be able to put up a portion of the money at the auction. If you walk out without putting up that percentage, whatever it is, in that domicile, you don't get the property. Well, if you've got the money at the custodian, there's no way you can do that deal. Whereas if you got the money in the bank account, you can write a check. You can have a debit card, ACH, wire. It's just a bank account. And You have full freedom, no fees. So it's kind of all upside, very little downside.
So with that being said, then, I mean, it sounds like, and I'm sure that's not what it is, but it sounds like you're just basically a bank account that's protected by retirement accounts, so to speak, right? Because whoever is investing this money, those listeners out there that don't know, you can invest your 401k or your IRA into real estate, for an example, and it can grow, and the money can grow tax-free as long as you don't ever touch it. Okay. So the same thing probably goes with you. How do you structure this?
Absolutely. So there are a couple of different structures that we use, and let's break it down to its components so it's understandable. Broadly speaking, there's the qualified plan approach, QRP approach, and then there's the IRA approach. So let's talk about the qualified plan side for a moment. So qualified retirement plans include so many different plans, defined benefit plans, 401k plans, profit sharing plans. There are just so many of them. What we focus on is using Checkbook solo 401ks because that's where we can really give people the pure upside and no downside of having a 401k plan. 401k plans can be very complex and costly to administer. But if you are an owner-only business without full-time employees that are non-owners, then you can have what we call a checkbook 401k. So it's got to be a solo. It's got to be a one participant.
Right.
But a solo doesn't really mean that's only one participant in the plan. As long as the people in the business are owners or spouses of the owners, and there are no other full-time employees of the business other than spouses and owners, then you can have that solo plan. And the IRS kind of says this is a solo plan, no employees that are not owners or not married to owners, so we can take it easy on you. Really no annual testing, no annual compliance, no ACP testing, no ADP testing. There are all sorts of stuff that go into 401k plan. But when you've got a solo plan, the IRS says there's really nothing for you to do. So we set up this plan. The plan does not require a custodian. That's a mistake that people think that a qualified retirement plan needs a custodian. No custodian required. We set the business owner up as the trustee. Then we set them up with an account, a bank account that's for the plan, and they're good to go. So they can roll over money if they've got prior 401k plans. They've got prior IRAs, traditional IRAs, 457, 403B. You know, you may not know what all those are, but if somebody works at a hospital as a doctor, a firefighter, they'll know what those things are. They can roll all that stuff into this plan, have direct access to it, and put it into real estate. And it's also a powerful tax vehicle because it's got the ability, you can take $55,000+ in tax deductions per participant each year. So it's a really powerful tax vehicle and a really powerful investment tool.
So let me ask a question on that. So I know that on a 401k, you're limited to what you can borrow from your 401k to $50,000 per year.
That's right. Mm-hmm.
So therefore, if I had a solo 401k plan or a qualified plan at all, and I wanted to put it into your bank account, the max I could do is $50,000. Is that right?
That is wrong.
Wrong. Okay.
The idea is that we're keeping it in the 401k plan. So the loan option is a great tool. But first, what we're talking about is investing inside the plan. So inside the real estate plan, there's no limit whatsoever. Inside the 401k, you can put millions of dollars into real estate. You can roll over unlimited amounts of money into it. The loan option is a really neat option. Say you've got a personal expense. You want to put money into your business. You've got to pay for a car, for education. Well, normally you can't touch money that's in a plan, that's in a retirement plan without tax penalties. Well, you can take a loan of up to $50,000 for anything that you want. You can use it for an investment or not, but that's about taking money out of the plan tax-free without any taxes or any penalties. And that's where you got the 50K cap.
Right. But if you leave the money within the account, you never take it out, like what you're talking about within this checkbook style, right?
Yes.
Then there's no limit?
There's no limit whatsoever. You can roll over millions of dollars. And annually, if you want to make new contributions, you want to put new money in, you're right, it's limited to about $55,000 per participant, a little higher if they're older. So if you want to get new tax-deductible contributions in there, you hit those caps. But once money, you can have millions of dollars in the plan and invest the millions of dollars into alternative investments and real estate, debt, and equity.
So let's say you only wanted to put a portion of your 401k or other qualified plan, within your account so you can control it. And I'm asking you for a specific reason.
Yeah.
Is that possible to do that? Is that something that?
Yeah, there's total flexibility. You always have the options of having money in multiple retirement accounts. But it's also worth mentioning, sometimes we got people say, hey, I want to put some of my money into real estate and some of it into mutual funds. Well, our plans can be invested in mutual funds as well. It's not about taking away options. It's about expanding the options. So you can do everything within this one plan if you'd like, or you can keep some of your money in your old plan and some of it here. So there's so many different ways that can be approached, and you've got full freedom and flexibility to do any of those.
So, and tax wise, you're going to have the same tax benefit as what is in that qualified plan, right?
In general, yes, unless, and this is going out doing some more advanced strategy. Some people like having Roth money,
Yeah.
which is after tax money, but it grows completely tax free. So within the Checkbook 401k, you can get $55,000 of Roth every year, regardless of your income level. In the IRA space, you can't do that. There are income caps, but IRA contributions are capped at $5,500 per year.
Yep.
So if you want to, hit up that Roth money, then you're going to have to do it through this account.
Huh. And are you limited to what you can invest in with the funds that you move over to an account with you?
So the key thing is we're only limited by what the IRS does not allow.
Okay.
And you made to hear they're very permissive. They allow anything other than collectibles. So you can't buy rugs and alcohol and vintage autos.
Can you invest in PPMs and?
Yes, absolutely.
How long does it take to get one of these set up?
In practice, we get it set up in about 3 business days. But being that you got to move money around and set up the bank accounts, we tell people allow up to 3 weeks.
Okay.
Because you got to interface with the other custodians. So allow up to 3 weeks. So don't be coming to us, say, I got a deal tomorrow. Can we set it up?
All right. So if I was like, hey, I have a deal tomorrow, I need the money right now. You can't, the answer is no.
We can try. It's just not likely because we can get you set up, but your money's sitting wherever it is. In all likelihood, again, that's still that institutional system, giving them the paperwork. They got to process it. They got to wrap their head around it. And it's going to take them a couple of days.
Okay. Well, we'll certainly talk outside of this, but so that is with the qualified plan. Now, what about the IRA plan? Because it's a little bit different.
Yes. So the IRA plan is a little different. And I just want to wrap up the qualified side by saying sometimes we insert an LLC inside the qualified plan for people that want enhanced asset protection or that want streamlined investing. Sometimes you come to a closing and you're like, okay, who's the owner of the asset? Well, it's going to be the Scott Bauer 401k plan. And the attorney's like, I've never seen that before. So sometimes we'll put an LLC in there. And this way, like, okay, who's buying it? Oh, it's an LLC. He's got no reason to know that the LLC is being held inside of a qualified plan. So that's just to wrap up that segment. The IRA side is just a little more complexity. And whenever we can, we advocate for the Checkbook 401k. But in order to have the Checkbook 401k, you've got to have some sort of income that you're generating from a business that you own. That's the key way to qualify. So not everybody can have that. And now having a business does not mean you've got to be running a huge enterprise. You don't need a corporation or an LLC. It just means you're making some money that you would put on a Schedule C on a tax return.
Okay.
That's all it means. And by the same token, if you've got an LLC or a corporation, but you're not doing any business, it's just sitting there because sometime 10 years ago, you thought about starting on it, you're just doing an FBA, Amazon FBA business, but it's doing nothing. That's not a business either. You got to be doing something in it. That's the key thing to qualify. The IRA side, an IRA does require a custodian. So the tax code says the IRA's got to have a custodian. So we need to come up with a structure that allows us to kind of jailbreak it and get you the money in a bank account. And the way we do that, in most cases, there's some alternatives, but in most cases, what we do is we create a special purpose investment vehicle inside the IRA. And the best way to understand it is think of it, if you've got an IRA right now and you buy stocks and you buy Amazon stock, you're a shareholder in Amazon. Now, Charles Schwab does not care what goes on at Amazon. He doesn't get on the phone. Charles Schwab doesn't say, hey, Jeff Bezos, what's going on at Amazon? What are you doing? What are your business plans? Tell me about it, right? You buy the stock, and then Jeff Bezos does whatever he wants to do inside of Amazon. Likewise, we can kind of create a company. We tell the custodian, hey, we're making an investment. The IRA is becoming a shareholder in this company. Okay, send the money to the company. We're doing the IPO, initial public offering, and you send the money to the company. The IRA becomes the shareholder of the company, becomes the owner of the company. Well, now the IRA's money is in the company, and the company's management will do whatever they want to do, just like Elon Musk does whatever he wants to do.
That makes sense. That actually makes a lot of sense. It's a good way to kind of get around that.
And what happens is what happens now is, if you're in your fee structure, custodians will generally have asset-based fees. So sometimes they'll give you a fee they have lots of different pricing models, but they'll charge you sometimes per asset. Okay, you have 1 ppm. Okay, that's X amount of dollars per year. Another syndication, that's another, oh, you sent out money, we sent out a wire, here's another fee. But what happens is now the IRA only holds one asset. It made this private equity investment in this one company. And that's the only asset the custodian sees. Inside of that asset, you can add 100 investments. There's no fee because the custodian is not holding those assets. The custodian is holding this one private entity that we set up. So you completely obliterate those fees, no transaction fees, because you've got the money in a bank account and you're managing the company, and you can just write the checks whenever you want.
And you get to pick and choose where you want to put that, at what time you want to put that, and you ultimately have ultimate control over it. Why is it that more people don't do this?
It's the biggest reason is frankly, it's about education and awareness. That's really the primary thing. People being aware or maybe being intimidated. Sometimes people don't have the education, but even when they do, it can seem intimidating. A lot of moving parts. And of course, our role is to say, we got you covered. Don't sweat this. We've done this more times than we can possibly count, and we're just going to be there for you. And then the other thing is sometimes people think that the fees are really high. And so they're figuring, I'm not going to bother with this. This is really, really expensive. And we make it very cost effective. And I'd say, and all our clients, regardless of what they're doing, by year 2, they're already ahead. It's possible that their year 1 initial outlay is higher than it would be otherwise, but by year 2, they're always coming out ahead. And so that savings just keeps compounding year after year. And something that we know is sometimes, just last week, I had a phone call with somebody, and she's like, obviously she's just doing her stuff on the internet and Googling and calling everybody that Google serves up. And she's like, okay, so you said a checkbook IRA is that $4,000? I'm like, no. I never said anything remotely close to that number. You got to make yourself a list, write down the names of the companies that you're calling and their pricing, so that when you're done doing all your homework and calling everybody, you'll go back to the right person.
Make sure you get your facts right. That's funny.
I don't want them thinking that we're the ones charging $4,000 to set it up and then going with somebody else.
Right. So
so you know, our pricing, I wouldn't want to put that on the air. It's a fraction of that.
Okay. Yeah, I was going to say, is there a pricing specifics? But I'm sure that it's a little bit different for everybody and how much money you're moving, and there's probably just
no, we don't. Our pricing is the same if you're moving $1 or $10 million.
So can I ask you what it is?
I would.
Or should we?
I'm going to give it to you. Okay. I'll tell it to you. The only thing is these podcasts get up here, they stay here forever. And somebody may be listening to this in, 2 years from now, and the pricing may change. So I would just say that it's really, really reasonable. There are a couple of different moving parts, and we're very happy if everybody's educated. So I'll tell you how we do it now. Is that we kind of try to get there's a fee to reinsure. There's a cost to a custodian, and then there is a cost to the state just for having the LLC. So unlike the checkbook 401k, where it's just reinsure, there are 3 different components of the checkbook IRA. And what we try to do to streamline things is we try to give a flat price that includes the LLC cost in it, unless you're in a state like Massachusetts that charges $520 for an LLC.
Then you have to obviously add that on top of that because it's not. So
we add some components on top. But yes, some of our competitors, let's say, are charging $4,000 to set it up, and they'll say we'll give you a flat $4,000 because their margin is just so high, right? They've got this $3,000 cushion what's another, paying an extra few $100s to Massachusetts.
Right.
So in our pricing structure, that's really cost effective. Yes, if you're doing Massachusetts, we're going to hit you up with another couple $100.
So, it sounds like, this is something that can benefit people that want to take control of their retirement plans to invest in other assets that they might not otherwise have access to in a way that doesn't need a custodian.
Yeah, it will need the custodian, but if you work with our partner custodians, they give you rock bottom pricing. And because they're like, hey, we're not doing anything anyway. It's totally hands off. It's like, it's mailbox money for them.
Right.
Because they're not doing the work. They don't have the account. They don't have the money. Okay, you come in, sign up through Reisz. We've got, they know that you're coming through us, and they give you this rock bottom flat pricing.
So, what is the difference between a self-directed IRA or self-directed 401k and you guys? I understand the checkbook side of things, but tell the listeners what the major difference is, why they want to go with Reisz.
So the major difference is you get total control, you get total freedom, and it costs less in almost all scenarios. So I don't think any more reason than that. The question is like, hey, why not?
Yeah, absolutely. Why not? This is one of the things, and I'm glad that you came on the show today, because this is definitely a powerful piece of investing in real estate, investing in a lot of other things as well. But having access, I know that self-directed or IRAs, 401ks is one of the largest places in the country where massive wealth is held, not making any money. And so, like you had mentioned just a short while ago, people are not educated when it comes to what they can do, what their options are. And so, I'm glad for all the listeners out there that are listening to this, take some action. Give Bernard a call. We're going to go into where you can contact him here just shortly, but figure it out, and then I could be your vessel if you want to know where you can put your money.
Yeah. It's an all around win-win for everybody that's involved. If you're the investment sponsor, if you're the investor, it really we've got a lot of syndicators that are complaining that dealing with custodians is just a nuisance. And this is a way to kind of marginalize the custodian and deal directly, take out that third party.
And I think I know the answer to this question, but you're not geographically, it doesn't matter where you're at in the country, right?
Absolutely not. Sometimes people think we're in California because on our website, which by the way is an encyclopedia of self-directed accounting, self-directed retirement accounts. If somebody wants to nerd out on this stuff, go there, figure out how to navigate through all the podcasts, all the pages, all the blog posts. There's more info about this topic than there is probably anywhere else if they want to go through that. But yes, we're not geographically limited. And our picture, like we use a lot of Golden Gate Bridges all over our website. But I'm in New York City. And sometimes people get the impression we're in California. But the truth is, perhaps one of the messages we want to convey is that it's no matter. East Coast, West Coast, we've got clients in other continents.
I believe that. Yeah. With the way technology works today, you're not geographically constrained hardly at all anymore. And
not at all.
Right. Well, yeah, right. I can't be in New York City right now, but I can get an iPhone out and you can show me what it's like. Right. So Bernard, I appreciate you sharing all the information. I think it's super, super powerful. And the differences between kind of a self-directed IRA or 401k and you being, checkbook handy. You can just write yourself a check. You have ultimate control and really low fees. I don't think it gets any better than that. You can utilize it to really increase your retirement plans, which is huge. And for sake of time, I'm going to get into a lightning round. Are you ready for a lightning round?
Let's do it.
All right. What is your hashtag invest this tip to keep our listeners moving forward?
Be educated. Don't subordinate your judgment. That means be aware of the fact that you are ultimately your own CEO, your own board of directors. You can outsource some of the execution, some of the tasks, but you are your own financial steward.
That's awesome. Great tip. Thanks for sharing that. Do you have a favorite book that you've ever read that's had a massive impact on your life or business or both?
Let's go with Naked Economics.
What is it?
Naked Economics.
Okay, explain that just a second. I have not heard of that book before, but it sounds great.
Okay. In Naked Economics is actually, there's a whole series of books. It doesn't sound great. I don't think anybody calls it the Naked series. But the author is Nick Whelan, if I remember correctly. Charles Whelan is the name. He's got a couple of excellent books on all sorts of financial topics. So economics, he calls that undressing the dismal science. People think, but economics, it's nerdy stuff, geeky stuff. But really, it's a social science. And when you understand economics, you understand what makes the world turn, what makes finances, what dictates everything around us. So I think it's a great read. There is a part of it that is kind of statistical and stuff like that. But overall, it'll give you a different worldview.
So, hey, it's one of those books where if you want to nerd out and learn all about how the world ticks, that's a book to read.
That's right. Let me know when you finish it.
Who has given you the best advice that you've ever been given that has severely impacted how your life is run?
It's something, you get the greatest advice. And I'd say sometimes at the time that you get it, you don't appreciate it. And it's only when you get closer to actualizing it that you realize, hey, that was the best advice I ever received. And I know now I'm on the right path. And I'd say it's about being yourself, having the confidence to be yourself, to get out in the world and take action for yourself. Not to think that, sense of security, not to think that other people know better than you. We've got to, again, come back to that subordination of judgment. You are your own master. You can define your own future if you have the confidence to do so.
And that's such a true statement. Absolutely a true statement. I've taken a little change in my business model right now, based around that concept on doing what you really want to be doing and not doing things just because they make money or just because you feel like you must do them. Right. So, thanks for sharing that. I really appreciate that. How do you like to give back? Of course, we so much success around us all the time. How do you like to give back?
A couple of different ways. One way is really by providing knowledge and value and tips to people that they're not going to hear anywhere. And so they can be empowered. And then I also like connecting people to opportunity. So as somebody that's out there, a business owner, there's so many different things that cross my path. Some things are for me, some things aren't. Sometimes it's somebody that's looking for a job. I'm like, hey, this is not for me, but I know somebody that you may be a good match for. I've got really funny stories. One guy, I was looking to hire, and somebody said, I have just the right person for you. And obviously something was wrong with the communication, because the guy calls me up the next day. He's like, Eric said to call you. And I'm like, I'll tell you a little about what we do. And if you're interested, he's like, well, I'm looking to be a pastry chef.
Not exactly the same.
I'm like, that's great. We're not a good fit, but I've got a friend that owns, an artisanal bakery shop. I'll hook you up. I don't know if anything came of that, but those are the kind of steps I like taking.
Oh man, that is a funny story. Not even close to the same job description. That's funny. Where can the listeners reach you? Of course, we dropped a lot of knowledge today about the power of being able to control your retirement accounts, right? If they want to get involved with you, maybe move some money over, maybe, figure out how they can utilize their own retirement accounts for their benefit, where can they reach you?
The best way to kick things off, and the reason why this is the best way, it's 24/7 at 401kcheckbook.com. That's 401kcheckbook.com. So in there, we've actually got a button there. You can click schedule now. You can get on our calendar. You can actually access a portal. You can send us a message, and that's 24/7. We'll respond. We'll answer questions. We'll get in that meeting, and we really want people to be informed. Watch those webinars, listen to those podcasts, read those pages, because we want people to know that this is the right thing for them. They should know all the possibilities, but also know the rules that apply to these things. We touched on some of them, but the key thing is use it for investment only. But we want people to know what they can or can't do. When they get on the phone with us, we know, hey, this is a go. This is a great fit for you. You know, you want to get into real estate. You want to put your money there. This is the structure. We're going to make that happen for you seamlessly.
That's phenomenal. Bernard, I really appreciate you being here. This is Bernard with Reisz. You can go to 401k checkbook.com today to get signed up or figure out what the next steps are for you. Yeah, it's a wealth of information. Apparently, there's a ton of data in there that you can get into, figure out if it is the right fit. I really appreciate you being here today.
Scott, great to be with you. I love doing this. Maybe we'll do it again someday.
Yeah, let's plan to maybe move some money over and then we'll talk again after that.
Oh yeah, sounds good.
All right, Bernard. Thanks a lot, man. Talk soon. I was doing it again, man. My Zoom keeps freezing, and I don't know why. So I don't know. I'm gonna have to cancel out of it. But let's plan to stay in touch. The reason I asked is I'm trying to. I need to move like 25 or 50 grand over to an apartment deal that I'm trying to get in the next 7 days.
Oh, okay.
And I have some money in a 401k it's sitting there, and I could definitely use it. So if it's not on this deal, let's keep in touch and try to talk and figure out what the next move is.
Yeah, who's got the money right now?
It's with Creative Planning. So it's a fiduciary advisor.
Got it. So I don't know who the custodian is. Somebody, got to see each investment advisor at the back end. There's somebody else that actually holds the money.
Mm-hmm. Mm-hmm.
And if it's 7 days is doable, but no guarantees.
Right. I get that. I mean, I don't know. I'll probably just end up cutting a check right now because it's easier to do that but I think we should talk because it is something, it's a powerful piece that I would like to, I'd like to utilize. That's for sure.
Yeah. It's also, are you raising money for your own deals yet?
Not yet, but it's about to start. That's really what kind of what I've made a decision. Like I flipped a whole lot of houses, but it's not what I want to do. It's not that fun for me. So
this is also, even if not just for yourself, it's about fund capital raising. People sometimes say, "Oh, I'd love to put money in your deal as a debt or equity, but I don't have the cash right now." And you're like, "Well, do you have an IRA? Do you have a 401k?" Hey, now we're talking.
Right. Well, and actually, I'm gonna actually target 401k and IRA holders. I'm gonna send them some direct mail and see if I can raise money that way. Because I think I'll be able to. I'm pretty good at doing that. So we'll see. But I got to try and hop off this and cancel out of this. Is it easy for you to just cancel out of the meeting?
Yeah, I just guess kind of X that out.
Yeah, I guess. Okay. But hey, man, we'll be in touch. Thanks for coming on.
Take care. All the best, Scott.
All right, see ya.
Make sure to like, subscribe, and share this podcast to help us spread the word. Go ahead and reach out to Scott Bauer on all the social media outlets for suggestions on topics and guests for the show. And check out investthispodcast.com for more secrets and resources to achieve real success in real estate.